And here is Tim Pickering, founder and president of Auspice Capital Advisors. Great to have you here.
Thank you very much.
Tell us about this new product.
Well, I mean, you both have described it very well. What we're trying to do is allow access to the public in general to manage futures, and it's a big step. This has been an area that's been heavily invested by institutions for many, many years. Globally, it's a very well-accepted strategy, and in Canada, it's been something that's been very underserved and difficult to access. We do run a hedge fund in this space as well, but this is the first opportunity to offer a product to the public in a very cost-efficient manner.
So what are the differences between, say, the hedge fund that you would offer to an accredited investor and an ETF that anyone can purchase?
Yeah, the hedge fund is more complex. I describe it as it kind of is all the keys to the castle of our experience as fund managers institutionally. To launch a successful ETF, it has to be simple, transparent, and we have to give up the strategy. It's public domain. So any investor can go to our website or Claymore or look at the index that is the basis for the ETF and look at the strategy, see exactly what we're doing. It's completely public domain.
How are the indices connected to the actual ETF?
So every ETF has an indice that is the basis for the strategy. So the index is essentially the strategy. It's what we're doing. It's the weightings of the fund, essentially. The fund just mirrors the index. It's the index that really is the strategy that we're following. And we created that index.
So I'm really interested. You just mentioned that one of the elements of doing this through an ETF is that you have to lift up the kimono and say, here's what we're doing. So I presume that doesn't mean, though, that the average investor sitting at home in their pajamas clicking on their mouse could replicate it just because they know what it is that you're doing with your algorithms.
I think it would be difficult to do, but it is possible to do. Again, the methodology document for this strategy in the index is public domain. You can go to our website and download it. It's not all the details, but it gives you broad brushstrokes as to how this strategy works. On a daily basis, the positions are published by Claymore on their website, so it's completely transparent.
And what's your role then in this ETF?
Right. So the first role we have at Auspice is we worked with Claymore on providing a product in the managed futures space, looking at our alpha program, our hedge fund program, what are the elements from that we want to include in a simple format, coming up with the concept. Then Auspice created the index, the Auspice Managed Futures Total Return Index. That is calculated and published by a third party, the New York Stock Exchange. Then Auspice's role is to manage the ETF itself, actually put the investments on and put the trades on.
So you had mentioned to me earlier that you're not going to be including equity indices as part of this. What will you be including? Talk about the basket.
Right. The equity indices is an important differentiation. We felt the reason for not including it was quite simple. Most investors, especially in Canada, are very overweight equities in general. It was also a differentiation point from other managed futures strategies to not include equity indices. The basket includes energies, metals, agricultural futures, as well as currencies and interest rate futures, which is a fairly common managed futures basket without the equity indice overweight.
So this thing is meant to zag when equity markets zag. I mean,
that's
the
exactly
idea?
it.
Yeah.
The whole idea of managed futures in general and why it's so heavily used institutionally is it has a low correlation to traditional asset classes. It's really that simple. If you look at the volatility of the returns of managed futures historically, they're quite low versus the traditional methods of investing. Even for our Auspice Diversified Trust, our hedge fund program, the volatility of our returns is 25 to 30% less than the stock market. So we commonly, as commodity fund managers, get pushed in this corner of volatility of returns and a risky asset class. The reality is quite the opposite. The volatility of what we do is very low compared to the other choices.
Okay, so the volatility is low. What kind of returns, let's get right to the heart of the matter,
Sure.
What kind of returns could we expect?
I'm not in the business of predicting because I really don't know. I can tell you in terms of what we've done in our alpha program. The Auspice Diversified Trust has a 3-year annualized of about 13%, which puts it in the top 15 or 20 of all alternative programs in Canada. It was the top performing managed futures strategy in Canada in 2008 and the second highest performing alternative strategy in 2008. So if we can replicate that or even better returns with the ETF, given it's only 95 basis points, those returns that I've given you for our hedge fund include the 2 and 20. If we now only have a 95 basis point cost for that ETF, the returns inherently will be higher.
And very briefly, when do you hope to list and where will you list once again?
This is a Toronto Stock Exchange listed ETF, as other ETFs that we sub-advise for Claymore. The ticker is CZF, and it should be trading in the next couple days.
Thanks very much, Tim.
Good luck.
My pleasure.
Tim Pickering, President and Founder, Auspice Capital Advisors. We are back with Alternative Investing. I'm here, of course, with David Kaufman, President of Westcourt Capital. And today we are talking about a hedge fund strategy, David, called Equity Market Neutral. What's that all about?
This is great because we're now at the stage in this show where we're going to start talking about some specific hedge fund strategies. And this is a true absolute return hedge fund. A lot of words that I just said there. So first of all, absolute returns. We just talked about it in the managed futures context, that what you're trying to do in a strategy that's absolute is that you're not trying to benchmark against an index. What you're trying to do is you're trying to have positive returns in any market situation. And if you were to compare it to anything, it would be to the risk-free rate. So say the 5-year rate of, say, 2 or 3%, which you could achieve without taking any risk at all on government bonds. And so in addition to it being absolute return, it's a hedge fund. And a true hedge fund, going back to the Alfred Jones approach, is a fund where you make bets that you can't win all the bets, but the idea is that you reduce volatility, that is, you reduce risk, so that you might mute gains, but you also would dramatically mute losses. And so what we have in this case is that with the managed futures, we had a market-neutral approach, but it wasn't based on trading equities. This is based on trading equities, and the idea is that essentially the same metrics that someone would use in their calculus of determining value for what is undervalued, something you should buy, you can also determine what's overvalued, something that you might want to sell. And so if you can go long on undervalued securities and go short on overvalued securities, the idea is that eventually you'd have what's called convergence, which is that all the things that shouldn't be will eventually not be, so that the overpriced will come down and the underpriced will come up. And that is, and what happens there, if you're a good picker, if you apply the right metrics, which is all about manager expertise, which is also called alpha, is that you strip out what is called beta. Beta is the market going up and down. And what you're left with is pure manager expertise, and that's alpha. And that's why I'm so excited to talk about an equity market neutral strategy, because it is a true, pure hedge fund with little or no market exposure.
So what metrics would you use then? The manager would set out and say, look, I'm going to try and give you 4 percentage points above risk-free, and is that the benchmark they've got to beat?
Well, different managers would have a different approach, but I can certainly tell you about the metrics that I would use if I were trying to determine whether the fund were doing what it said to do. So the first, of course, is returns, because when you're looking at any fund, you'd like to know what kind of returns they've had. So if you were to look out at the universe of so-called market-neutral hedge funds, and you look, for example, at Picton Mahoney or at Sentry, and today we have Sentry on the show with us, you would see two market-neutral hedge funds that have done just what we said, that in good markets they've done well, but not as well. In bad markets, they've done okay in a positive sense and not had the large drawdowns, large losses, and that would be a very important element. But then you want to look at the number of up downs versus the number of up months, versus down months. How many were there and how big were they? You'd want to look at what people refer to as drawdown. By the way, most of this would be on a fun fact sheet that you would get to be able to look at it. The drawdown would be in any given time since inception of the fund, what's the largest number of percentage points that fund value has dropped during that time.
Is that a euphemism for loss?
Yes, it is.
Go on.
Then you can actually measure alpha. We talked about it earlier. You can measure what the alpha, what the skill is, and higher alpha is a good thing. And then finally, correlation. It sounds like a broken record. We talk about correlation week after week, but it's very important if you claim to have a market-neutral fund, the correlation over the long term to the broader markets, especially in an equity market-neutral fund, should be as close as possible to zero. So we're betting on the alpha and we're stripping out the beta.
Because often we have found in the past that hedge funds were long.
Well, exactly. The hedge funds today, the term hedge fund has really just become a way to describe the comp system, the 2 and 20 system, rather than actual hedging strategy. Today, what we're talking about, true hedge funds.
Well, coming up, as David just told you, Sentry Investments has a market-neutral LP division that was awarded Best Relative Value Hedge Fund by Morningstar Canada. We're going to talk to the portfolio manager who runs the fund next on Alternative Investing. Welcome back to Alternative Investing. You know who I'm here with, David Kaufman, president of Westcourt Capital. Our conversation about equity market neutral hedge funds continues. With us is Andrew McCreath, senior portfolio manager at Sentry Investments, who runs Sentry's market neutral LP. Great to have you here.
Pleasure to be here, gentlemen.
So the idea is that you produce steady returns, but you don't crash when the market crashes.
Yeah, our goal is to generate positive returns on a regular basis with low volatility, irregardless of the general direction of the market.
Okay, so tell us. Let's get right to the action. Talk to us about what your returns have been like, because the returns really do tell the story about whether you've applied the strategy that the fund claims to provide.
Well, the fund has generated a compound net return to the end investor of 8.7% over the last 6+ years. Mm-hmm. Now, that's all fine and dandy, but what's most important is that of 74 months that we've been in business, we've only had 3 months where we've lost 1% or more in a single month.
Well, we're having a look right there now, because this is pretty interesting. The TSX is the red line, Andrew. Your fund is the blue line. So you've matched the TSX. Some people might say, well, big deal. But most managers haven't. And your volatility has been practically zero compared to the market.
Most people care most about preservation of capital these days, especially given that in the last 10 years, a lot of investors have had 2 periods where they've lost 50% of their money.
And look at the S&P.
Now, bond yields are 3% right now.
Right.
At some point in time, an investor is going to give up 2-3 years of coupons in a matter of months because rates will go up. Could be a couple of years from now.
And bonds will tank.
That's correct. Now, as you saw in that graphic, you notice the market went way down and then it went way up, and the fund just kept ticking along. The tortoise beats the hare.
Right. So let's
it's
just
the
talk
sleep
about
at night fund.
Viewers may have noticed that at this exact point in time, so on November, December of 2010, it just so happens that your fund and the TSX are at exactly the same point. But correct me if I'm wrong, but that's purely coincidental, right?
Just a point in time, David.
Okay,
yes.
because it's crossing through you. You're doing the short, the steady as she goes approach. Can you talk to us though about what it would be that would cause an anomalous month, a negative month, or even an anomalously positive month to occur?
It's stock picking. You and I both know that an investor, if the investor's right 6 times out of 10, they're doing a good job. People just like to tell you about their winners, but we all have losers. So the reality of it is I have good months and I have bad months. And generally speaking, an anomalous month is going to be due to stock picking. Okay, and so because you have longs and shorts, can you talk to us about, do you go long on the equities that you love and then short the index, or do you do what people refer to as paired trading, which is where you go long on equities that you love and you go short on equities that you hate, using the same sort of calculus to determine what you love and what you hate? I will utilize single leverage ETFs. However, I generally go stock versus stock. So long a gold stock, short a gold stock. Long a pharma company, short a pharma company.
Okay, so if the company that you're long, say, buys the company that you're short, that would probably be a bad situation.
That would be a bad hair day.
A bad
my worst experience occurred about 3.5 years ago, and I was long and short 2 U.S. medical laboratory companies.
Right.
And I woke up one morning, and the short had stolen a large Blue Cross contract from the long.
Oh.
And that was the catalyst for me to put in place a principle that I follow, and that is to collapse my U.S.-based pair trades ahead of the release of quarterly results. Because often good or bad news comes with quarters, and to try and mitigate risk, I collapse ahead of quarters to decrease the likelihood of a bad event happening.
Okay, so that wasn't a one-time. That's your new strategy, that you collapse it ahead of the quarter.
You learn by your experience.
Right.
And about 3.5 years ago, I had one of those bad hair days, and that's when I put that new rule in place.
What if there was a long, drawn-out, grinding bear market where there was no stocks that would go up for you, but everything had gone to such a low valuation you couldn't find anything much to short?
Well, in the 2008, we only made 1%.
It was ugly.
It was an ugly market, but we made 1%, which
was pretty darn good. Yeah.
Right. But the reality is we didn't make a lot of money. And one of the reasons we didn't make a lot of money was the correlation between securities went up a heck of a lot.
Everything went up.
And the correlation, of course, is how closely do two things move together. Mm-hmm. And normally you can separate a good from a bad company, and they act differently. But when the correlation goes up, you can't make any money.
Okay, so we have correlation, let's say, approaching 1. You have two securities. It's almost impossible to make money if the correlation is that high, if I understand what you're saying.
Right.
Because your short is they're both going to perform as you expect them to perform.
Right.
You have to extract a fee because you have to make some money along the way, and what you're left with can be minuscule.
Right.
And so that's what would happen in that scenario.
I'd like to make one other comment, and that is in the spring of 2009, then everything went up.
Sure.
But there's a catch. The lousier companies went up more than the good companies.
Yeah.
Which, of course, correlation went to 1, but it also went a little differently.
Sure.
And you generally tend to short lousy companies and go long good companies.
Right, so let's understand. So a hedge strategy is not a risk-free strategy. It's a risk mitigation strategy.
Well, a manager has to have their own principles and tools that they utilize to ensure risk management is well demonstrated in the management of the portfolio. And I have my set of rules, which we don't have time to chat about today. But again, it's all about the tortoise beating the hare, no big bets. And when you look at the return of a security, it's alpha plus beta plus income.
Right.
And the alpha is the movement in a company's share price that is attributable to company-specific factors, a company changing for the better. Whereas the beta is the movement in the price of a stock that's attributable to the market moving or the price of gold going up or down $200. Mm-hmm. So the idea of a market-neutral hedge fund is to isolate the alpha, hedge out the beta. And by hedging out the beta, you dampen the volatility.
I got to ask him, what are you shorting right now? If you won't give me any company names, can you tell me what sector you're looking for shorts?
Well, we always have shorts on the book, Andy. I mean, this is a North American equity fund. Mm-hmm. We typically have up to 20 paired trades on the books at any point in time, and they're broadly diversified. So technology, industrials, consumer staples, financials, gold.
Who are you shorting in tech? Can you tell us that?
We're short IBM. We're short the quadruple Qs. Which is an ETF for the NASDAQ 100.
The big names in tech.
Yes, we're long Hewlett-Packard. We're long Apple.
Okay, so you're naming some very large securities. I've heard a number of equity traders in Canada. A number of times they've mentioned to me that it's difficult to short in Canada because of the inefficiencies in the market. Do you do paired trading in Canadian securities as well?
Sure, we do. But I mean, obviously, you go to certain markets for certain types of stocks. So when it comes to my Canadian exposure, it's in the golds, the energies, the REITs.
Right.
As an example.
High volume, popular Canadian type of stock.
No more than 10% small caps in my fund, and there's never been a private security.
You mentioned pair trading, just to remind people. So you're looking often at two companies in the one industry.
Yes.
So that way you get away from the fact that this jubilation lifts the entire industry.
Well, that's the way to hedge out the beta.
Yeah, exactly.
Right?
And but you short the company you don't like, and you buy the one you do like.
Correct.
Or you could go long on a company that you love that has its own alpha built in that you just discussed, and then you could short the index for that sector, not just the index for the market as a whole. Is that right?
You could, yes, absolutely.
And which would you prefer? Because it's a lot of heavy lifting to try and identify at the same time something you love and something you hate in a specific security, isn't it?
Well, again, it really depends. Like in the gold sector, for example, where there's the general euphoria that you referred to a few minutes ago, you may tend to short an index ETF and have smaller weights in a couple of names as opposed to just going to single stock names where they could get driven higher by drill news,
right,
or a catalyst event.
Okay, so then how many times in the course of a year would you turn over the same dollar?
I would turn over the names in my portfolio about 40% in a year, and the dollar value of my turnover would be about 200, 250%. Partially attributable to the fact that I collapse my U.S. pair trades ahead of the release of quarterly results as a risk mitigation tool.
At least 4 times a year. Then.
We've got to leave it there. We've got to have you back more often. Fill an hour with you, Andrew. Thanks very much.
Thanks
gentlemen.
Andrew McCreath, Portfolio Manager at Sentry Investments.